All right. I'd like to take this opportunity and to discuss question number 5 on your chapter 4 homework. Okay. And again, if you have not attempted this question, please work out every step on your own before you continue watching this video. All right. So, this company is a soft drink company, and the company until today bought empty cans from outside supplier, and that was charging 20 cents per can. All right. In addition, the transportation cost is $1,000 per truck that actually transports 10,000 cans. Okay, and the company is actually thinking about whether they should actually start manufacturing the cans in their own plant. All right. So the cost of a can machine is 1 million, and the lifespan is 12 years. Right. Terminal value of the machine is actually $160,000. Okay. Apparently, that is the book value. Right. And maintenance and repair cost will be $150,000 every 3 year period. Okay, additional space for the new operation will cost the company $100,000 annually. Right, and the cost of producing a can in a factory is 17 cents per can. All right, the cost of the capital for this company is 11%, and corporate tax rate is 40%. Okay, there's a lot of information here. Right, this is asking what's the minimum number of cans that the company has to sell annually to justify self-production of cans. Okay, all right, so there's a hint here. It says start by guessing the annual production. Let's say you guess 3 million cans, and then you're going to actually use solver to correct the guess by making the MPV equal to 0. Okay, and here the MPV should be the differential cash flows between your own production and outside supply. All right, so let's think about this one here. All right, analysis. All right, so it's about buying or manufacturing their own cans. So it's a capital budgeting problem. All right, in with taxes, okay, and it was depreciation. All right, and etc. Okay, so we need to think about the MPVs. All right, to calculate the MPV of this project. Okay, so I'm just going to go ahead and build a timeline here. All right, this is actually for 12 years for this machine. So I want to actually build a 12 period timeline here. Okay, and we're actually thinking about the MPV of this, differential cash flows or the incremental project of going from outside supplying to own production. Okay, all right, so let's look at the machine cost. Okay, the machine cost is actually $1 million, right? So I'm just going to put down $1 million here. All right, so it's negative. All right, that's the machine cost. Okay, and we're going to look at the if you produce the cans on your own, you're going to look at first of all, you're going to look at the savings from producing your own can. Okay, all right, savings from producing your own can as compared to buying the cans from outside. Right. So, well, I have to look at number of cans because the savings actually depends on the number of cans. Okay. All right. All right. So I'm going to, I should say, annual savings. All right, and I need to actually, find or guess the number of cans. So I'm just going to take the guess here. All right, minimum number of cans to produce. All right, and I'll just follow the hint and I'll just guess 3 million cans. Okay. All right, so now we're looking at the annual savings of, producing your own can as compared to buying those cans, from outside suppliers and transporting those cans to your factory. Okay, so you're gonna have this 3 million cans, all right, and oops, I should say 3 million cans, and if you actually produce your own can, that's gonna be 17 cents per can. Okay, um, and if you actually buy the cans, it's going to cost you 20 per can, but you also have the transportation cost, which is actually 1,000 for 10,000 cans. So that's like 10 cents per can. Okay, so the total cost of outside supplying is going to be 30 cents per can. All right, and if you actually produce your own can, you're going to spend 17 cents per can. So if you do the algebra, that's going to be 20 cents plus 1,000 per 10,000 cans. Okay, that's the per can cost, right? And if you do minus 17 cents, that's going to be your total savings. Okay, that's $390,000. All right, but you also need to look at other things. So, for example, you need to look at depreciation. All right, so now you're actually buying this machine, so you can actually think about the depreciation. The machine cost is actually 160,000. Excuse me, 1 million. Okay. All right, and the residual value is actually 160,000. That's the terminal value. And if that's the case, the difference, well, I just made a mistake, so I should actually do 1 million positive minus 160,000. All right, and this is actually depreciated over 12 years. Okay, so your annual depreciation is going to be $70,000. All right. In addition, you're going to have the fixed cost. Okay, fixed cost per year from your own production. All right, and your fixed cost is going to be the additional space you need to actually operate this machine, and that's going to be 100,000. Okay, and you also need to think about the repair cost. Okay, so the machine is now you're going to maintenance the machine for every 3 years. All right, so I should say every 3 years. All right, whoops, every 3 years, not 4 years, and that cost is going to be 150,000. All right, so if that's the case, I can actually think about the cash flow from this incremental project. Okay, so this is the initial machine cost, and now I'm thinking about in the first year you're going to have this amount of savings, but then you're going to take out the annual fixed cost, and then you're going to actually take out the repair cost every 3 years. So there's no repair cost. And if that's the case, I need to take out depreciation. All right, and I can now pay tax. Okay, so 1 minus the tax rate, and that's going to be 40%. All right, and because I took out depreciation, I need to put back depreciation. Okay, so that is the cost in the first year, and I need to lock down this number here. Okay, all right, so that is the cost for year 1, and I'll just copy this across. But now I have to think about what's the difference caused by the repair cost. So this is year 3. All right, so now I have to think about, well, every 3 years, I need to repair the machine. So that is going to be 150,000. I think I made a mistake here. So let me just get back this number here. This is actually 150,000. Okay, that's 150,000. All right, so now I have to knock off this 3-year cost, every 3-year cost here. All right, and that is going to be causing a difference. Okay, all right, so that's actually 100, 112,000 in year three. Okay, it's actually less because you're actually spending money repairing the machine. Okay, and the same thing here for year six. Okay, because this is another 3 year. All right, and the same thing for year nine. All right, so I need to actually take out that. Okay, and same thing for year 12. So let me take out the repair cost every 3 years. Okay, all right. So now let's actually look at one more thing here. In the in year 12, you actually have the terminal value of the machine. That's actually 160,000. Okay, so we should put back the 160,000. All right, and all right. I think there's a confusion here. Uh, so the repair cost 150,000. That is actually every 3 years. So it is a little confusing, or it's a little unclear as to whether you're going to incur the $150,000 at the end of year 12. Okay, so and that's going to affect our cash flow in year 12. So here I'm going to assume there's no need to actually repair the machine at the end of year 12. All right, so if that's the case, then look at what I'm doing here. I look at the $390,000 savings minus the annual depreciation, minus the annual fixed costs. All right, so there's no every 3 year repair cost at the end of year 12. All right, and then I pay tax and I put back depreciation, and I pick up the terminal value. Okay, all right, so that is giving me $362,000. All right, so I should make it clear. Assume there is no repair cost at the year 12. Okay, all right, and if that's the case, then we can replicate the answer from the homework. All right, so I'm going to look at the MPV here. The MPV is going to be discount rate is what's the discount rate here? 11%. That's the cost of the capital for this company. Okay, and I'm looking at the future cash flows. All right, and I'm putting back the initial investment. So this actually is a positive MPV project. Okay, oops. I just need to format this as a dollar here. All right, this is saying if you're actually producing $3 million, then this incremental project of going from outside suppliers to your own manufacturing, that's a good project. Okay, now I'm going to invoke solver. Okay, I'm going to set, all right, B13, equal to 0 by changing my gas, which is J3. Okay, and that's how we can actually, find out the minimum number of cans you need to produce in order to make this incremental project at least, not negative. Okay, all right. So I'm going to bring up solver here. That's my objective cell, and I'm going to do this by changing my gas. So click solve. Solver says I found a solution here. In order for you to make it break even, you should at least produce essentially this number of cans. All right, and you can also calculate the IRR if you want to. All right, so there's a tiny difference of 21 cents. All right, which is probably okay because we're dealing with very large numbers here. All right, and part B, this is actually using the data table to show the MPV and the IRR as a function of the number of cans. So I'll just build in the data table, for MPV, okay? And you can do that later for IRR, all right? So I'm going to look at number of cans here. So I know the answer is going to be this number here. So how about we just go from 2.5 million right, to let's say 2.6 million, all right, 2.5 plus 100,000. Okay, so that's 2.6 and 2.7, 2.8, 2.9. All right. So these are the hypothetical cases for the number of cans. And here I'm going to look at my NPV. All right. This is the, I'm building this data table in a row. Okay. And now, based on what we discussed in class, you should highlight everything here and go to data, what if analysis, data table. And now my row input cell is the number of cans. And when I build my NPV calculation, I use this number here, okay? My column input cell is blank, so I can actually, make this data table work, right? And this is saying if you're actually producing 2.5 million cans, then the NPV is negative, so it's not worth it. If you actually produce 2.6 million cans, the NPV of this incremental project is positive, so it is actually worth it, right? And if you produce 2.7, NPV is actually even better, okay? All right, so this is the data table for NPV, all right? I can do IRR here if I want to, all right? So I'll just go ahead and do IRR here. All right, take all these cash flows and I get 11% IRR, and that's 11%, and that's not a surprise, because the number of cans is the minimum number of cans. So at this level, the IRR should be equal to the discount rate of this company, which is 11%. All right, so I can build building the data table for IRR. So I'm going to look at IRR of, let's say, how about we look at 10%, all right? And this is just for illustration, okay? So in the real world, you would have to decide what is a good range for instance, the different discount rates, okay? So, whoops, I think I messed up here, all right? I should look at number of cans, we're trying to build, all right? So these are the number of cans, and I'm doing the IRR here, okay? So I'm going to look at all this thing here, and I want to populate the IRR for all these different numbers of cans you're producing. So I'm going to do data table, what if, all right? And my row input cell is the number of cans. My column input cell is blank. So now you see that if you're producing 2.5 million cans, your IRR is less than the 11% discount rate, so it's not worth it. But if you are producing 2.6 million cans, your IRR is higher than the discount rate, so it is a good project. Okay, so either way, you draw the same conclusion for NPV versus IRR. All right, I hope this is useful.